So you want to scale your real estate portfolio by using other people's money. I think that is a fabulous idea. The question becomes, how do you do it? And how do you structure a deal like this? And that is the topic of today's video. And the short answer is to use what's called a syndication. And it's really just a fancy word for partnership. And it lets investors like you partner on bigger real estate deals like apartments with other investors. So in today's video, I'm going to go show you how to structure something like this, your first syndication. I'll walk you through some of the potential returns and the economics of a syndication, and so that you know how to apply that to your first or maybe even your next apartment building deal. So first of all, what is a syndication? It's really at the basic level a partnership between two groups, the GPs and the LPs. The GPs are the general partners and the LPs are the limited partners. The GPs typically, they do all the work, right? They'll find the deal, they put the financing in place, they manage the property manager. And then the LPs are limited partners, and they in turn put all the money in. And it's really a great partnership because the GPs get paid and create basically sweat equity for putting the deal together. And the LPs get the benefit of real estate without having to do the work themselves. So they get access to cash flow, appreciation, and the extraordinary tax benefits. So it really is an amazing win-win. So let's go through an example to see how a syndication works. So for example, we're in Atlanta a lot, and so we're buying a $4 million deal, and that's going to require $1 million raise, 25 units, average rent per unit $1,750 per month, and we're getting a 30-year fixed mortgage at 6.76% interest, 70% loan to value. All right, so just look at the syndication structure here right now. So we get the general GPs, and they're doing all the work. They receive the sweat equity, and typically the advantage of being a general partner is that by doing this, by getting the sweat equity and the acquisition fees and the asset management fees, you can literally replace your income in 1 to 2 years, which is amazing. Now, you got to do all the work, but it is an amazing, powerful vehicle to achieve financial freedom. The LPs, the limited partners, put up all the capital, and they too receive a percentage of the cash flow distributions and profits and tax benefits. And typically, when you passively invest, you can, in fact, replace your income as well in about 5 to 10 years, which is amazing, which is in the stock market takes 50 plus years to do potentially. So let me give you an example here. This Atlanta deal that we're buying, we need $1 million. So general partners, we do all the work. And for that, let's say you get 30% in sweat equity. And the limited partners who put up all the money get 70% of the deal. It could be another split. It could be 60-40, 80-20. But typically, this is what happens in the syndications. And this is how you can buy a $4 million deal with other people's money. That's in general how that's structured. Now, let's look at the profit centers. This is from the GP perspective. The LP has its own set of profits, so that for the acquisition fee in this deal that we already hinted at is 3% of the purchase price. So this would be $120,000 at closing, and that's paid to the general partnership. And you typically are probably going to have a partner, right? So if you have access to capital, you're probably going to partner with someone who's got deal flow and can manage the asset, things of that nature, right? But typically you're splitting $120,000 at closing, and this allows many people to quit their jobs after their first deal, right? Imagine you got $60,000 each, you got another $60,000 of savings that you're willing to tap into. Now you have a year runway, and you decide to focus on this full time, because if you do that, you can scale a lot faster, and that is true. So this makes this a very, very powerful, probably the most powerful a vehicle for becoming financial free as well. So now the general partners get this 30% sweat equity, and that generates about $100,000 of fees and income. Let's take a look at how this breaks down. This $100,000, you have about $12,000 per year of asset management fees. It's typically a percentage of income or rental income. Then you have an average of about $200,000 of cash flow. And we're assuming you're holding this for 5 years or so, right? So $42,000 per year in cash flow on average. In the beginning, it's going to be a little less. In the end, it's going to be a little higher. But on average, it's about $42,000 a year. And it's about $200,000 worth of profit at the end, divided by 5, again, would give you an average of $42,000 a year. So that, if you add all that things together, is about $100,000 per year over 5 years. So that's $500,000 plus the $120,000. Now, this one $4 million deal now can generate $620,000 over 5 years, which is amazing. And imagine you're not just doing one single deal, right? If you can do a single deal, then could you think that you could do it again and again and again? And the answer is, well, yes. I mean, if I can do it again, if I can do it one time, I can do it again. Now, you might not 100% believe that you can do it even the first time, or even how to do it. I'll talk about it in a second. But let's say you can. And you got a partner, you got someone looking over your shoulder, whatever. You have access to capital, access to deal flow. and you have now this $4 million deal. Well, if you can do it once, you can probably do it again. And this is why this is such a powerful vehicle, because not only can I now use this to get out of whatever I'm doing in the next year or possibly two, but now I can build extraordinary wealth and extraordinary cash flow as well. And that's powerful. And this is what Ryan Kindred and Russ Cannon did. Their first deal, it was a $4.6 million self-storage in their case. A lot of students are doing some other commercial real estate. The principle is very much the same. The first time, and Ryan was mostly responsible for raising the capital, he raised $2.1 million, which he did not think he could do in the beginning. But he's a great guy. He's a personable guy. He just needed to learn how to raise money, and he got the playbook, and he ran with it, and he raised $2.1 million, and he split a $130,000 acquisition fee with his partner, Russ. Now, the cool thing about a syndication is, it's fairly simple, a split between GP and LPs, but it can be used in more complex situations. So, for example, one example of a complexity is, in the most basic one, you have a deal finder and a capital raiser GP. Those are always the cleanest, but sometimes, let's say, you don't qualify for the loan yourself, or you don't have the net worth or the experience for it, and now you might need a guarantor who signs on the loan. Well, how do you compensate that person? You give them a sliver of the general partnership, 5 or 10%, things of that nature. Maybe someone else is going to put a deposit down or fund the due diligence cost, let's say. Well, you would compensate them with potentially a percentage of the general partnership. So the general partnership could be made up of multiple people who are all playing very small roles and are compensated in that way. But you can also, syndication is also flexible because you can incorporate what's called fund managers or capital allocators, right? And these are people, I collectively call them capital raisers, but you don't always have to put a capital raiser into a general partnership. They can be used as LPs as well. And because they're larger check writers, they're going to come in with, let's say, a minimum of $500,000 or $1 million. Those larger check writers might get some preferred terms with you. They might get a better split, for example. And so this induces investors, instead of putting in the minimum, to write a little larger check, because then they get more. They get more equity, for example, in the deal. So you can structure things in much more flexibly than what I've outlined here as well. The good news is you don't have to really worry about the details of this too much, because your SEC attorney is going to guide you through all that stuff, right? You have to be aware of the structures as I just talked about it here, and then the attorney will implement everything as well. Now, we did this at our last deal, our Waverly deal up in Norcross, Georgia, where we actually had a couple of fund managers in there as well, and they were preferred limited partners in the deal. So a lot of people have been doing this over the years. It's a very legal way to raise capital as well. Now, I just went through an example of a syndication, and so can you see the power of this, right? The power of the structure between GPs, one or two partners, multiple partners, and these LPs who are getting the benefit of real estate, right? And so this one deal now over 4 years can earn you over $600,000 per year. Let's say you do, one a year, right? Over the next 5 years, you can generate millions of dollars in this way. And it's just the most efficient, the fastest, and the most fun way, in my opinion, to scale with real estate, because I always have a team around me. Back in the house flipping days, it was basically all me. And the only way to really scale was to work harder. Didn't really appeal to me. And the same thing for putting together a rental portfolio as well. I would need a lot of rentals to generate $10,000 per month in income. And so it really wasn't a viable path forward. This is very much so. And we've done it now since 2014 for hundreds of people from all walks of life. And you might still not be 100% convinced that this is for you and you believe you can do it, but it's actually surprisingly simple if you follow the right system. So I want to introduce you to that system in my next video. And in that next video, I kind of break down the process into really 4 main pillars of what you got to really pay attention to as you start getting into this world of multifamily commercial real estate. It's about building your team, raising capital, how to analyze deals quickly, generate deal flow, and doing so, and closing your first multifamily deal in as little as the next 6 months. So if you're interested in that, then go watch that video. I think you're really going to enjoy it, get a lot of value out of it, and I will see you there.